Well, as Tom just mentioned, the board of the nation's dominant brewer and one-time global wannabe, Foster's, this week accepted a sweetened $12.3 billion bid from its UK-based stalker, SABMiller. While the new bid represents a 13% premium on an earlier offer of $4.90 a share that the board had rejected twice before, the increase will in large part be paid out from shareholders' cash already held in Foster's. Neal Woolrich reports. Well, let's just talk about the takeover offer. It's been rejected out of hand and you're not engaging with them, is that correct?
That is correct, yeah.
John Perez, good morning.
Good morning.
So what finally got you and the board across the line?
Look, we've had a very close look at it, obviously, and been thinking about this for quite some time, and we think it's a very compelling offer for shareholders, and certainly the directors will be voting their shares in favour.
What a difference a few months can make. After refusing to even talk with SABMiller when it lobbed an unsolicited takeover bid in June, Foster's is now embracing its suitor.
Ultimately, this is a great deal for the company and, frankly, a great deal for the staff and our customers. It's a terrific company.
SAB are a very good company. They're internationally focused. They understand brand management, and so I think it's a good transaction.
The reason for the abrupt change is an extra sweetener in the mix. SABMiller first offered $4.90 per share in June. Now it's come back with $5.53. But included in that price is a 30-cent capital return and a 13-cent final dividend.
It's a PR type thing for SABMiller to be able to imply that Foster's had excess capital and that's being returned and they're only paying $5.10.
It's Foster's shareholders' money that seems to have been used to bump the bid beyond $5.10, which is what it looks like as an underlying bid. So, yeah, I think that's a reasonable statement that the true price isn't quite the price that Foster's management are talking about.
John Guadagnuolo is one of many institutional shareholders poring over the deal.
We haven't exactly made up our mind that we'll accept the offer. Obviously, we have to go through all the details. But, in the absence of another offer, it looks reasonably compelling.
But he questions why Foster's board is talking up the bid price by including the capital return and dividend.
You wonder why they're doing that. Does it speak of a poorer underlying demand condition than they might have anticipated when they were aggressively rejecting the bid in the first place?
Whichever price is used, though, there's general agreement that Foster's shareholders are getting a decent return.
I think it's a good offer. I think Foster's hasn't been a very strong performer over time, and if you look at how the share price has performed and how the business has performed over time, Foster's is getting a very good multiple, 14 times EBITDA.
It's at least a 20% premium. Our standalone valuation of Foster's was $4.44, and I think ex any takeover premium in the share price, that's roughly where it would have traded, if not a bit lower.
Inside Business understands that Foster's board was intent on getting a price-earnings multiple above Lion Nathan's when it was snaffled by Kirin 2 years ago. Thanks to some creative number crunching, they've managed to achieve that, but only just. When Foster's own shareholder funds are included in calculating its enterprise value, its takeover multiple is just above Lion Nathan's. However, if we measure Foster's enterprise value by excluding the 43 cents per share of capital return and dividend and adjust for Lion Nathan's higher depreciation expenses, Lion Nathan achieved a slightly better outcome.
At the end of the day, the price paid is one that hasn't been able to be delivered by Foster's organically for a long period of time. So as a shareholder, you sort of think, well, that's how it is.
So it's, to us, on most metrics, a premium. There are some where it's a discount, but broadly speaking, a premium. And that's appropriate. Foster's is a 20% larger business. It is a more profitable business in terms of margins and returns. And it's at an earlier stage of a turnaround strategy.
Paul Ryan says the takeover has been brewing for 2 years after Foster's had a change in board, management and strategy. Recent sales results might also have played a part.
Trading conditions have been challenging, and the market share trends, which had stabilised for a period, had started to deteriorate again. Don't want to overemphasise a month here or there, but the ability to stabilise market share without having to discount, I think, was proving somewhat challenging.
One man who understands Foster's challenges is Peter Bartels, who led the brewer in the early 90s.
Look, people focus on the brands of Foster's, Victoria Bitter and all of those. But what supports those brands underneath is outstanding technology by CUB. CUB could well be the world's best brewing technologist.
Peter Bartels says that technology helps Foster's replicate the taste of its beers around the world and would prove a valuable asset to SABMiller. He plans to accept SABMiller's offer but expects there'll be changes under the new owners.
Look, inevitably you'd look at the brand portfolio. We did it in my time when we acquired People Courage in the UK, Molson and Carling O'Keefe in Canada. Of course you rationalise the brands, you rationalise the production assets, but beer's always better when it's made fresh, and so you want your production bases as close to the market as you can get them. So I think SAB will know that very well, and I'm certain that the production capacity that is in Australia will continue.
But whatever course SABMiller takes with Foster's, it won't be repeating the mistakes of Foster's board and management over the past 2 decades, which blew billions of dollars on its foray into winemaking.
I think they got distracted. Distracted was trying to grow the company in width, basically going into the wine assets and a whole host of things. I wasn't privy to the discussion, so it's a little unfair to comment on them because at the time they probably would have looked good.
They've destroyed value. It's a very strong beer business, very high returning, high cash generative business. You could say pretty comprehensively they have wasted that position by buying overpriced wine assets that are not necessarily compatible with beer assets.
There seems little chance the bid will be knocked back on either competition or national interest grounds. All that's left is for shareholders to have one more shout at a scheme meeting in December. And that could well be last drinks for a group that's been in Australian hands for 150 years.